Good afternoon, everyone. Welcome to the show. Today we've got a 2023 stock market update. We're going to do Q&A. We're going to answer any of your questions live today. So welcome to the show. We've got Rob Tetrault, portfolio manager at CG, and myself, Tania Tetrault, as well. So please make sure that you send us any comments or questions that you might have today. We're just going to be talking a little bit about all these things that you're thinking about as we start the new year. And we're going to get our finances and our portfolios in order. So how are you doing, Rob? Monday morning?
I'm awesome, Tanya. I've been really good. I'm good. What are we, Jan 16th? Feeling really good. I've been, as I think most of my fans and viewers know, I've been jogging a lot. I've been running a lot of races. I signed up for an ultra, so I'm doing 50 miles next month in Houston. So that's going to be the first time I ever do more than 26 miles. So it's also a trail run. So the mileage for the training has increased. So like I have to do 25 miles on Saturday. So, I've never really run 25 miles on a treadmill. I'm running across Manitoba also in May. So Run with Rob, it's going to be called. It's going to be launched next week officially, but it is live now. So if you go to www.runwithrob, you could see what I'm doing. Basically, I'm trying to convince the Manitoba government to put universal screening in place for newborn babies for congenital CMV infection. It's the number one cause of infant disability. It's a charity that my wife and I started to address this huge shortage that we have in society. So we now have universal screening in Saskatchewan and Ontario. So I'm going to run from Saskatchewan to Ontario, and I'm asking friends, family, viewers, fans, whoever, runners to come run with me. We're going to have a motorhome. It's going to be like Terry Fox, inspired by Terry Fox's Marathon of Hope. And I'm doing 24 half marathons in 12 days. So 12 marathons in 12 days. And Tanya, are you going to be doing one?
I am. So if you know me, you know that I always prefer kind of like strength sports and running has never really been my thing, but I do like to run outside. So I think this is a fantastic cause. This is actually, something where we can actually make a difference here. You've made a difference. We've made a difference. So this is absolutely amazing. We're going to save some lives, save some newborns' lives essentially here. So I figure, you know what, I can run a little bit. I can run for a few hours. I think I can manage that. So I did my first long run this weekend. Long is not like you, 25 miles. Did about 8 miles, but considering that the most I've ever done is about 5K, I think we're doing good.
8 miles is phenomenal because so it starts May 12th. So you have 5 months and you're already doing 8 miles. Like they kind of say you should get to 3/4 of the distance by the time, you're at the event. If you're doing 8 miles today, to me, Tanya, that means you could do 13 miles tomorrow. So congrats.
I feel like I could, but I don't want to get hurt. And I also want to do a good job for this cause. I haven't picked my leg yet. So if you guys go onto the website and see Run with Rob, you'll see all the descriptions of the different half marathons. It was really cool. I checked that out yesterday. So now I don't know. I want to start thinking about, what would be a nice scenic route to do.
Yeah. So I think we'll try to get the link up here. We'll put it up on the screen, but there's 24 legs. The ones out west, out in like, Verdon and Carberry and Portage and Brandon, they're kind of downhill. They're flat. They're downhill. You're in the open. You see the Canadian prairies. If you've ever wanted to run across the Canadian prairies and see forever, like that's kind of neat. And the ones out east, Falcon Lake and Haddishville and all that, they're wooded, right? So it's you're entering to the Canadian Shield, and you got beautiful scenery. So say what you want about Manitoba. We have a very scenic province, and I'm going to see all of it. But I mean, depending on if you want to see the prairies or if you want an uphill leg, or Winnipeg, we're going to have 2 really fun legs through Winnipeg. You should sign up for those as well. So anyways, it's open to you guys to run with Rob. Also, my brother and I are launching a podcast in the next couple of weeks. It's called The Running Journey. So people have been telling me, Rob, you've been on an incredible journey here. You lost 60 pounds. You're running Ironmans. You're running across the province. You should tell your story, and you're a decent storyteller. So my brother and I are doing a podcast, and we're going to launch that as well, which is going to be The Running Journey. Anyways, enough about that. Should we talk about the stock market and other things?
We should probably talk about that. I mean, it's that time of year. So what are, some of the things that we want to think about at the beginning of the year? We want to think about things like, whether we want to be topping up RSPs, TFSAs. I don't know if we want to start with that or if we want to start with kind of markets.
Yeah. Let's start with that. So the TFSA contribution limit, $6,500 for this year. That means if you've never contributed and you were 18 or older in 2009, so that means you were born in 91, or later, you have $88,000 of TFSA contribution room. So if you have the liquidity to do that and you've already maxed out your RSP, that's an absolute no-brainer. So if you have $6,500 of spare capital sitting in a rainy day fund, I often see individuals, clients, friends, family, they'll sit on cash in their checking account at the credit union and they'll have a rainy day fund. Then they'll accumulate, which is a good idea. That's not a bad idea. But instead of having it earn $0 or 1% or 2%, you should have that invested in a TFSA at some level. That doesn't mean you need to own stocks, but you should be investing and you should be gaining a little bit more than that. And it could still be your rainy day fund. I love the TFSA concept as a rainy day fund. I don't know how you feel about that, Tanya, but it doesn't have to be a forever savings account, right? It can be a rainy day fund. Now, for some people, it is a long-term savings account where they're never going to draw from it. But for others, it's a liquid investment pool that you can draw from and use in emergencies. So if you're sitting on cash, you shouldn't. You should have that cash in your TFSA, especially if you have room. If you don't know if you have room, you can go to the CRA website with line 151 of your tax return or 152 of your tax return. You can get your TFSA contribution limit. So that's one thing you should be doing. Your RSP is 18% of your income up to a max of, what's it at now, Tanya? 20, I should probably know this by heart. 27, 28,000, something like that. Whatever the number is. It goes up slightly every year. And if you don't know if you should make a TFSA contribution or RSP contribution, Tanya, I don't know if you have thoughts on this, but for me, I like to say, I'll just say quickly what I think, and then I'll ask you what you think. But for me, generally, if you're in a high income tax bracket, above 80,000 or 70 or 90,000, you should be focusing on RSP contributions because you're going to get like 40 or 45% of that back. If you're kind of younger and have a lot of future earning power and you need that liquidity, I would focus more on TFSA. And if you're somewhere in between and you're not sure, there's nothing wrong with doing some of both.
That's exactly what I would have answered. I usually have a little bit of a kind of a little algorithm there. And the two questions that we usually ask ourselves is, what liquidity do we need on these funds that we're trying to invest? And what's the income situation? Do we need a tax break with the RSP contribution? And once you answer those two questions, it becomes fairly clear what should go into a TFSA and what should go into an RSP. I mean, we're very lucky here in Canada to have a TFSA as a tool. There's really, it's amazing. It's completely liquid. There are no restrictions on, no deadlines for contributing. You can take money out anytime and regain the contribution room the next calendar year, January 1st. So very, very flexible when it comes to anything where you need liquidity.
Yeah, I agree. So if you're not sure, obviously reach out to us, reach out to your advisor. By the way, if you'd ever like to book a no obligation consultation, go to www.speaktorob.com, speaktotanya.com, and we'd love to chat with you about your investment portfolio or anything else that's on your mind. Seeing the comment here,
my old student. Yeah.
Yes, Joel. All right. Yes, I did teach business communication at St. Boniface University for many years. I also taught at the Asper School of Business at the U of Manitoba, U of M, for years as well. I probably taught 10 years, and I loved my time there. It's just life gets busy, so I'm no longer teaching there. But I love those students, and it's fun to see them in the community, and they're all turning into successful business owners or professionals or whatever it may be.
Yeah, it's fantastic. So, you know what? I would imagine that we will get some questions live. If you do have questions, please put them up in the comments. But maybe what I'll start with, because it's timely, beginning of the year, people always ask us, what's the outlook? What do you think is going to happen in 2023? Now, obviously, we can't predict the future. We don't have a crystal ball, but there are some kind of indicators, I guess, that we can look at and some historical statistics we can look at. So why don't we take a look at what can we glean from, let's say, the first week in the markets, the first, let's say, 5-day stock indicator. What does that tell us?
Well, okay, so I like this because it's fairly simple, but it is a small sample size, much like the 30-year presidential cycle is. But the first 5 days of a stock market, if you measure them historically, if the first 5 days are positive, you end up getting something like, I think it's 83% success rate in that year being a positive year for the S&P 500. So that's a significant indicator. I think if you break it down, it kind of makes sense because you get momentum. Typically, if you get buying power in the first 5 days, it means that's kind of like the period where people are back from holidays or whatever. And if you're buying, if the first action that you're doing in the year is buying, that's typically can be seen as a good sign. I'm not saying it's the absolute end all and be all, but as an indicator, I think 39 of the 47 instances in the last 50 years or last 47 years, it's been positive 83% of the time after that. So that's,
and it could just be a positive sentiment indicator that, hey, had a rough year, 2022. Maybe people are finally kind of now looking at seeing the interest rates are starting to ease, the interest rate hikes are easing a little bit and people are optimistic. So it's always a good sign.
Yeah, for sure. And then if we're talking to other indicators, one that I really like and I've talked about before, and I know we have a comment here, Diego, so I'll let you post, or producer Diego post it in a sec, but the third year of the presidential cycle. So this one is this one is real. Again, it's a small sample size, but if you go back the last, I think it's 20 election cycles into third year, the U.S. market is averaging about, I think it's 16% in that third year, relative to 6 or 7% those other years. So historically,
16.79% is about right. So almost 17. Yeah.
Almost 17% versus 6-7% for the other year. So that's statistically significant, right? I get that it's only like a 20 sample size, but it's still enough that I think it's something, and it makes sense. If you actually think about it, why would presidents spend more in the third? Why would presidents spend more? Why would spending leads to positive stock market, leads to profits, leads to job creation, leads to dollars in my pocket. I'm spending more. If I'm buying more things, those companies are profitable. There's more jobs, there's more GDP growth, et cetera, et cetera. Why would that happen in the third year? Well, there's an election coming in the fourth year. So you want your voters, your clients in a good mood coming into the fourth year. You want strong growth. So historically there's a reason why this happens. It's not like just the first 5 days, or like the Santa Claus rally, or buy in May or sell in May and stay away, or buy when it snows and sell when it goes. I think this is more real. So 17% average in this third year. We are in a third year, and 6-7% the other years. How do you feel about that one, Tania?
I think, sometimes we just see historical indicators that are kind of really nothing more than just kind of, data. But I think when there's an explanation where you say, this makes sense because of what's happening with the election, because of what the candidates want to do to push for better economical situations when they're going to need to get votes, it makes sense. So I would agree. It absolutely makes sense. And I think those are good indicators to look at. And even though, we can't necessarily predict from them, it's nice to have some positive indicators when there's always a lot of doom and gloom out there. So it's nice to show the other side of the coin too. So, Diego, do we have a question here? Oh, we do. We have a question from Rodney Taylor. His question is, looking at TFSA, this should be our maximum return vehicle. Wondering what exactly we should be looking at. Oh, okay. So his point here, good point, Rodney, is that with TFSAs, we want as much growth as possible. Ideally, it's the ideal vehicle for growth, because anything that grows in there is tax-free, and withdrawals are tax-free. So any advice for that?
Sure. So, I mean, what you don't want to do in a TFSA is just load up on volatility. You don't want to just load, because, I think the question is, if I'm more likely to make better returns in tech or speculative stocks or small caps, which historically have the highest rate of return, why don't I just put all my money in the TFSA? So the reason is because you're going to get a ton of volatility. And if ever you need that liquidity, if ever you need to sell something to buy a trip to Europe or it is an emergency fund, right? So if you're doing that and you have to sell at one specific time and all of those stocks have corrected a ton, those stocks could correct 40 to 50%. And that has happened. So I would not advise clients to do their riskiest portfolio all in the TFSA. You need to have in your TFSA, some blue chip stocks as well. It's not a significant down. It's not a terrible idea to have some, private debt, some alternatives in there. They're generating 6, 7, 8%. And they're also going to be able to be there for you if you need the liquidity, and even some alternatives like private infrastructure. Those are really good because they add stability to the TFSA. So, again, the answer is it depends, unfortunately, Rodney, and it depends on your personal situation. And if you're using this as a savings account, or if you're using this to invest long-term, and what your tax situation is, what you have in your RSP, what you have in your non-reg. But generally, the concept is you want to have your highest growing investments in your TFSA, but you do need to have a little bit of diversification as well.
Yeah, excellent answer. I think it's kind of, it's funny that we always say it depends, but that is the case, right? Even whether it's a TFSA or an RSP, we still need to take a look at how much volatility we can tolerate, what kind of liquidity we need, and then from there we can take a look at tax treatment and all of that. All right,
Yeah.
we have another question already. Larry has a question here. How is the fact that there is over $300 trillion in global debt, most of which is government debt, going to affect the historical trends? Oh, are we talking long term here? I think that's the question.
Yeah, I know Larry's worried about the planet falling apart and collapsing, and he's got some concerns about what's happening with debt. So just remember that the GDP is significantly larger than it's ever been. And I know Larry will probably say, yeah, but the debt to GDP is also significantly higher. The debt is concerning, obviously. Like the size of the debt is a lot larger than it's ever been. But we've also have relatively low interest rates on a comparable basis. And I know that interest rates are higher today than they were a year ago. But, the 30-year and the 10-year and the 5-year bond indicators are telling us that interest rates are going to be falling at some point. We believe interest rates are close to peaking. They've not quite peaked yet, but we do believe in 12 months and 24 months from now, interest rates will be lower than they are today. So you have a declining interest rate. You have inflation, so therefore your debt is worth less on a real basis in a year from now. So I think the key that we have to look at is what kind of growth are we getting? Are we continuing to get GDP growth in these countries globally and in these countries? If we continue to get GDP growth and we continue to get spending and we continue to get population growth, that is good for corporations, which is good for the stock market. So obviously we're keeping an eye on the global debt, but I'm not as terribly concerned as you are about this, Larry.
Maybe it might be of value to take a look at kind of past growth bears, maybe past bear markets, to see what the history has been on those. I think we've got some charts on that, or at least some data on that, on what the S&P has done during past bear markets.
Yeah, I'll share my screen here.
Okay.
So you were talking about the last seven bear markets, something like that?
Exactly, because that might be a nice segue, if we take a look at kind of historical,
So if this is a chart here that's got the 7 last bear markets going back to the 80s. So this is Black Monday, the Gulf War, the Asian monetary crisis, the tech bubble, the financial crisis, that one we remember quite well, the trade war in 2018, and then the COVID sell-off. So this is what's happened during that period. And this is kind of the next 12 months after. The next one that we should add right here is inflation, the inflation crisis of 2022. So we've just had a 30% correction, and the year finished minus 20. So, what are the next 12 months going to look like? I don't know. But if we were to add a box right here that said inflation crisis 2022, and you were to add minus 30 or whatever the peak was, what would the next 12 months look like? Well, I'm optimistic when I look at this. This is the last 7 bear markets. I'm optimistic that, based on nothing more than historically when markets correct, they always make new all-time highs. So it might not happen tomorrow or next week or next month. This, we're up 5% already on the S&P in 2023. So that's a great sign, I think, for what's going to happen this year. And I don't know if it's coming in 3 months or 6 months, but optimistic. And I don't focus on the short term much, Tania, as you know, and the viewers that are listening. There will be a time real soon here we're going to go, oh my goodness, what a crazy buying opportunity that was to buy. And we were so scared that we didn't buy. That's what's going to happen unequivocally. It always does. Some things change, but when it comes to the stock market, it's always the same. You're too fearful to buy. You don't buy. And afterwards you're like, I should have bought. If you just buy every time there's a 20 or 25% correction in the history of the stock market, you're going to be doing unbelievably. What we did, we have a small percentage of our clients, very small percentage of our clients that leverage from time to time. They'll do a little bit of leverage. They're extremely high net worth. They're able to withstand risk. We leveraged for them back in whatever it was, October, November. We added investments to the portfolio with a plan. The plan is basically we're going to add a little bit of exposure to the market. And as the market recovers, we're going to sell that and you're going to profit from the recovery. And I know it's too short of a window to say if that was a phenomenal trade, but I'm extremely confident that that's going to have been a phenomenal trade. So I'm confident that without knowing what will happen short term, I'm extremely confident. And I like looking at these bear market charts.
I think that's a good way of looking at it is that whenever, instead of seeing bear markets as, something bad that we have to be afraid of, it really is an opportunity as long as you are in it for the long run, which is really the way to look at it in this particular case. Now, if we take a look at these bear markets, just going back to kind of Larry's question here, there was for sure high debt in these various financial crises as well. And we can still see that afterwards, markets recovered regardless. So maybe that can help for Larry a little bit too. And we have another question from Brad, this one. Oh, we get to talk about alternative investments. Fun. With alternative investments, is there the possibility for capital appreciation? Absolutely. It's just a little bit of a different experience for the investor because these alternative investments aren't necessarily traded on an exchange. So, you're not going to be looking at your ticker all day on these things. But absolutely, because there are some alternatives that are, infrastructure, private equity. Maybe, Rob, you can talk a little bit more about some opportunities for alternatives that have some growth potential.
Well, they pretty much
all do.
Yeah, they pretty much all do, except for the private debt component. So private debt component, we see as an alternative to fixed income. And the music royalty component, we see as an alternative to fixed income. It's kind of a hybrid.
But even that has some growth potential.
So if we break it down into the different alternative classes that we use, private real estate, let's start with that one. Private real estate, so that's multifamily real estate. Here's how it works. They typically pay a coupon 4, 5, 6%. That's the income is generated from the real estate holdings. The rest is the value of the appreciation of the real estate and the paying down of the debt. Typically, the private real estate investments, alternative investments, appreciate 4 to 7% per year in capital appreciation in addition to the coupon. So if we look at all of our alternatives on the private real estate side, they're all up anywhere from, we had one that's up maybe 2 or 3% last year, but the vast majority of them were up 8, 10, 12, 14% last year. And that's including capital appreciation and dividend payment. Let's move to infrastructure, private infrastructure. So that we use Starlight through Dennis Mitchell. They were up, I think, 19% last year. And of that, 4% is the distribution, the cash that you get. The rest is capital appreciation. Same thing. You own an asset that appreciates over time. There's paying down of the debt. It's worth more. The value increases. And how does the value increase? Usually it's monthly or quarterly whenever the auditors audit the value of the assets. So it's a third party, arm's length. It's professionally audited. They report, and then you get the increase on your statements. It's not like a stock where it's every day or every 2 days. It's usually quarterly. Let's look at other alts that we use. So we have farmland. So farmland, the way that one works is, again, it's a distribution. You buy the farmland from the farmer, you rent it back to them. They pay you 2, 3, 4% to use your land. You pay that to the unit holders. It's a distribution. And then over time, farmland appreciates in value. Same thing. That one is about 10, 12% that they've averaged and they did last year. So that's an appreciation of 7 or 8% on the value of your shares. Which other one, Tanya, here? Music royalties. Let's talk about that one quickly.
Yep.
Music royalties, you buy a catalog of songs or an artist's songs. You collect a royalty whenever the song is streamed, whether on an iPad, on an iPod. Is that still a thing, an iPod?
I had this conversation with my husband. He told me it's still a thing. I thought it wasn't still a thing.
All right. iPods, phones, PS5s, your Peloton, whatever. Wherever the song is streamed, a royalty gets collected by the owner of that catalog. It gets paid to my clients as owners of that royalty. And then the appreciation is the increase in value of the cash flow. So if there's more and more streaming, that music catalog is worth more, audited, and you get the appreciation. Private equity. Private equity is another alternative that we use. Private equity is owning non-publicly traded companies. So you buy them at a discount to what you think they're actually worth. And over time, you're paying down the debt. Company's worth a little bit more. When you pool them together, a group of 20 companies is worth more than one company. So you get an increase in the value. Did I miss one, Tanya, or did I catch most of them there?
I think you caught
There's the storage, a private storage unit, and commercial real estate. Same thing with them. You own a mini mall, you own a mini storage unit business. You pay down the debt, you collect the instruments, and the value increases over time. So all of our alternatives, every single one of them, increase in value monthly or quarterly.
but could potentially be used in, TFSA, RSP, really any kind of account, a non-registered account as well because of their tax efficiency. But yeah, absolutely. So
I
they're
think sorry, go ahead, Daniel.
so tax efficient because of the fact that, there a lot of them do have capital appreciation, which is taxed at a lower rate. And then many of these, all the ones that are real estate, do tend to pay return of capital for the distributions, which means you're also not paying tax on the monthly or quarterly distributions on those items as well.
We need to address this a little further here. The global retail investor. So I'm talking about Mr. and Mrs. Everybody every single day, not the ultra high net worth and not the institutions. They have 3% on average of their portfolio in alternatives. 3%. And it's not like the average have 3%. Most of them have zero. The vast majority have 0%. And our clients have 20, 30, 40%. Mm-hmm. And that's a significant reason why we're outperforming. Why wouldn't you want to own an asset class that has been proven over the last 150 years, or if you want to go back thousands of years, right? Like real estate has been an asset class that the kings and the nobles in the UK were owning, and that's how they built their wealth. And like, why would you own an asset class that's incredibly stable, that provides you with tax efficient income and is uncorrelated to the stock market if you can generate 8, 9, 10, 12% every single year? It's available now. It's accessible. It can be in your portfolio. I'm telling anyone who's not a client that's listening right now, like, you need to be discussing this with your portfolio manager. And if they can't do it, come see us. www.speaktorob.com. Canadians are significantly underweight alternatives, and they're suffering as a result. Their average Canadian portfolio last year was minus 14% or something, minus 12%. Our clients were significantly better than that. We're talking minus 2 or 3 or 4, depending on their asset allocation, depending on their portfolio. Like, it does wonders for portfolios.
And maybe some of our viewers or listeners out there might wonder why we tend to be so optimistic in the long term, why we're showing you all these statistics. But part of that is that our portfolios are very well diversified, and having these in there for us, it can create a situation where there's a lot less fear for our clients. It creates a much more positive experience, a less stressful experience. And so, for us to be able to do a market update like this, we know that these alternatives, real estate will continue to go up. We know that infrastructure, governments will continue to invest in infrastructure. We know that companies will continue to want to make money. And so these are basic principles in investing that we need to keep in mind, even when, things look a little gloomy, let's say on the inflation side of things, or so let's see, maybe we have some more questions. Please make sure you drop us a comment or a question. We've got another one here from Steph. Would ETF index fund be the best way to invest right now until the market stabilizes?
So I get the question. It's a great question, Steph. Thanks for sharing. So I don't think that you should be making decisions. You should be like dumping money into one specific thing or not because something is happening in the market. You should own a portfolio, Steph. And I don't know how big your asset is, how big your chunk, your net worth is, and your liquid asset is, but I would not be like investing in one ETF as part of a balanced strategy. Now, if it's a relatively small amount and you can't build a diversified portfolio because you only have 5 or 10 grand or 15 grand or something, then yes, you could look at some cheap ETFs like VOO or SPY or one of those ETFs to get you just broad exposure to the US market. But I don't think that's a strategy. I don't think that's a strategy for anyone who's got a real liquid amount. If you got 100 grand or 200 grand, you should not be looking at that. If you got $1 million or 2 or 5, absolutely not. So what you should be doing is you should have a portfolio. So you should have a chunk of your assets that's in equities or stocks, a chunk that's in fixed income, and a chunk that's in alternatives. What that mix is for you, I don't know. But each of those different baskets of assets, if you will, should have a different strategy. And if part of that includes an ETF, maybe that's great. But I wouldn't just say, oh, the market's not stable, I'm going to put all my money in X or all my money in Y. I just don't think that's a good idea.
And I think that's exactly right. I think the way to maybe address this, Steph, is to think, okay, you skipped a step here. So first, before we start thinking about what do we actually want to be invested in, what vehicles do we want to be invested in, the first question to ask ourselves is the investment objective, the risk tolerance, and then we can actually do proper asset allocation. And it's really only once you've figured out that asset allocation, which doesn't change based on market conditions, or not much anyways for most people, right? Your ability to stomach volatility probably won't change that much, whether it was 2020, 2021, or 2022, or 2023. So it's really, really important for you to ask yourself that question. What are my objectives? How long do I want this money to be invested? Do I need liquidity? How much volatility do I want to tolerate? And then once you've answered those questions and how much you want in each of your buckets, then you can start thinking about, do I want to use ETFs? Do I want to use stocks? Do I want to use alternatives?
Yeah, that's a very good point, Tanya. You're stepping us. I like that, how you describe that.
All right. Well, let's see if we've got any more questions here. Oh, Rodney's still listening. Awesome. Rodney, with the supposed increase coming in electric cars, what do we suspect will happen with lithium and uranium in the future?
Okay, so obviously there's going to be an increase in demand and for lithium and uranium. I think that goes without saying. There's going to be more electric vehicles. I think 10% of the vehicles delivered in 2022 were electric, which is phenomenal. I think that's very good. So there's no doubt that that's going to happen. The question is, and how does it apply to your portfolio? So these sectors are phenomenally volatile because they trade on emotion more than anything else. They are speculative, and because you're banking on something crazy to happen in the future, they tend to trade at absurd valuations when the emotion roller coaster cycle hits. And we saw that in 2021, 2022. Some of these stocks got hammered 89, like they rallied a ton and then they got hammered a ton. And it's just too much volatility for most people. So you can buy quality lithium and uranium companies, but they might still drop 60, 70, 80% because of the emotional cycle. So generally, I would stay away from small cap companies that are hoping to one day, capitalize on the change of government regulations or the change in demand for lithium and uranium, just because most Canadians, most of my clients, don't need that volatility. Maybe you'll make 20% instead of 10, but what if you're down 80%? Like, is it worth it to have that much volatility in your portfolio? What if the demand changes over time? So we tend to avoid highly volatile sectors as a rule, just because you're not being paid. You're not being compensated for taking that risk. It's not enough. And it's not like you're at the casino at the roulette table and you know that if you gamble on black or red, it pays, even odds. But if you're gambling on number 14, my favorite number, then you're getting 35 to 1 odds. Okay, I'm being compensated for that risk. Here, it's less likely to hit and you're not being compensated for the risk. So I would avoid most of these companies that are small caps. There are a few large cap companies that could make sense eventually if they trade at a good multiple. Companies that are not profitable, that are hoping to bank on a future kind of boom, those typically don't end well for retail investors.
What do you think about using something like an ETF for the entire sector, the electric vehicle sector, or something like that?
Yeah, I believe in that. If you want to take a position in the sector, if you believe that EV cars are coming, there's a really good ETF called Cars. It's by Evolve, I think. If you want to take a play, but it's got more than just lithium and uranium. It's got some EV companies. It's got some component companies. That kind of play can make sense. But again, more volatility, and I prefer that play, Tanya. So good question. I prefer that play than just buying a micro cap uranium company and hoping they don't go bankrupt.
It's slightly less speculative, slightly more diversified way to get that exposure if that's something that you're really looking to do. Let's see if we've got any more here, or do we? Oh, we do. We have a question from Eric. So the question is, why not looking at ETF if you have more than $1 million? Oh, good question. So what's the reason behind wanting to avoid ETFs? Because this probably relates back to the old question from Steph there.
Yeah. So I can handle this one, or you can, Tanya, or whatever.
Go for it.
Sure. My opinion is that if you have over $1 million, you deserve and should have a custom portfolio. ETFs are created. They charge fees. They're passive investments. You are sure to underperform the benchmark by the amount of fees. It's incredibly passive. There's also a spread that's being taken. I see what's happening on the back end of ETFs, the market makers. I don't believe that retail investors are being treated fully fairly on most of these ETF purchases. I'm not saying there's corruption. I'm just saying you're losing on the buying and the selling every time there's ETF trading. So I would rather you own 10 or 15. If you have $1 million, you can take 10 or 12 good positions in Canadian stocks or US stocks because you have enough assets that you could build your own diversified portfolio. If you deal with someone like us or a team like us, and then you can own the 10 or 15 best securities. The problem with ETFs is that you end up owning all of the sector, all 500 companies in the S&P 500, all 30 components of the Dow, all companies on the industrials index, or all the Japanese stocks if you're buying that Japanese ETF. So I don't think it's the best way to operate, because you're going to get the good companies, but you're also going to get the terrible companies, and you're going to pay a fee to do that, and it's going to be passive. There's not going to be an active management that's applied, which is what we do. So when the markets are being hammered, there's no strategy that's being applied. And when you rebalance an ETF, a lot of times you get screwed on that. So yeah. You have enough wealth to build a real portfolio. You should have a real portfolio.
Similar to a mutual fund, you're also stuck in a situation here where if there's one thing that you don't like in that ETF, you've got to throw the baby out with the bathwater. And then the other thing, of course, is that there are no ETFs for alternative asset classes, right? You can cover only traditional asset classes with most ETFs, and so they're really not going to help reduce the volatility at all, or act as any kind of really as a hedge in these market conditions. So some disadvantages there. So you might as well, if you've got $1 million or more, you might as well get a custom portfolio. All right. So please make sure that you drop us a like or a comment or a question. We've got another one here from Ronnie Taylor. So a small amount of cars in your TFSA might make sense. I guess he's talking about the cars ETF. He's looking for a small percentage. I think he wrote 10 to 15%. I guess that would depend on how that plays out with the rest of the portfolio and the rest of your net worth.
Yeah, again, it's got to fit in the picture. 10 to 15 of a $90,000 TFSA is 10 or 15,000, depending on your net worth. Absolutely, that's a play that you want to take. You believe in electric cars. It's not absurd, especially if you have an RSP, if you have a corporate account, if you have a non-registered account. That makes sense. I don't know your personal situation, Rodney, although I kind of do. But for other viewers, I don't know if you should be doing that. I don't want to give advice. I don't want to give specific advice. I have to be very careful to give specific advice to specific people over YouTube like this without knowing their personal situation. So it could make sense, yes.
All right, we're having some great questions here. Oh, they're still coming. I love it. Maybe we should do these lunchtime Q&As a little bit more often. We've got a question from Bob here asking about what the U.S. bond market is telling us at the moment.
So I believe Bob is asking us about the 5 and the 10 years. So if you look at, I'll just pull it up here. Basically, what it's telling us is that future interest rates are going to be much lower than they are today. So both the 5, the 10, where is my chart here? Give me one sec. So both the 5, the 10, why are these not updating? Anyways, I know them roughly, but okay. They're telling us that long-term debt is going to be cheaper than today. So the 5-year, sorry, Tanya, sorry.
That's
viewers.
okay. You're looking for 5-year bonds?
Yeah, the trading, it's 3.49 on the 10-year. And so that's telling us that, we have an inverted yield curve, right? So the 2-year is trading cheaper than the 10-year. And it's telling us that eventually interest rates will be a lot cheaper. So I think Bob might be also getting at the fact that inverted yield curves are a leading indicator of recessions. I don't know if that's what Bob's telling me, but we are aware of that. Obviously, the yield curve has been inverted for a while here. It's not new. It's not like today or yesterday. So if we're talking about recession, I will share a screen here. One thing I want to say is that stocks have historically been a leading indicator of the economy. So the recession, so this concept that we might have a recession in 2023, it might happen. I'm telling you. And in fact, in the past, I've said it will for sure happen. Now I'm saying it might happen. I'm allowed to change my tone here, but a recession is 2 consecutive quarters of negative GDP growth, right? So are we going to get a recession? Maybe, right? Maybe, probably, I don't know. And the leading indicator for that would be the inversion of the yield curve. But remember that the market historically peaks way before a recession, right? And then it recovers. The stock market starts recovering kind of before the recession ends, much before the recession ends. So this is just to remind people the concept that people think in their minds is a recession happens at that time when they announce it in the newspaper, my stocks will be down 40%. But that's not how it happens. That might be how it used to happen in the 1910s and 1920s and 1930s because we didn't have, Twitter and tickers and live updates to our stock portfolios. But as we get to the real age of real data at our fingertips, we've noticed that the spread between the market correction and the recession has gotten larger and larger because the market anticipates this recession. We are getting smarter as consumers. We're getting more fearful. I don't know if it's good or bad. We're getting more fearful earlier. So about a year or so before the recession hits, that's when your market is peaking. And about 6 months before the recession ends, that's when you get your rally. So, or 6 to 9 months before. So when the recession does hit, it's not like it's going to be news. It's like we've been talking about this recession now for a year. It's not like, oh my goodness, there's a recession. Oh, we had no idea it was coming. I can't believe it's here.
It's not like anything changes overnight.
No,
when that happens.
It's a technical definition, right? It's a technical definition, and it's got to be measured by GDP growth numbers, which are measured on a quarterly basis. So like a recession, what do most recessions indicate? They indicate job losses, a shortage of spending, and GDP contraction. So GDP contraction, shortage of spending. You and I would spend less less trips, less consumer discretionary stuff. So travel and luxury items and I don't know, books and whatever. We're buying less of those. That's a recession. Are we seeing job losses? We're seeing the opposite right now. Like jobs cannot be filled right now. So this is going to be a weird recession. If it is something that I don't think we've seen, a recession where people are choosing not to work, even though there's job openings, and and they're going to contract their spending to the tune of saving. So open jobs, and yet I'm not taking that job, and yet I'm not spending. So it's going to be weird, and I'm really curious to see what it's going to be
balanced now. And maybe while we're on this, I think an expression that we hear a lot, and maybe some of our viewers or listeners might not be familiar with what that means, but you hear the term a lot. It's already priced in. It's already priced in. So maybe we can explain for those who kind of don't know the lingo what that means. But that's exactly what this means, is that the sentiment of we're talking about these things, information gets disseminated very, very quickly in this day and age. And because investors are trading all day, every day, that information as it gets disseminated will affect that in the market already. So we're already seeing that. Do you have a better way of describing that? Because we hear that expression all the time. Yeah.
I like how you disseminate. My dad always says this, right? I haven't mentioned my dad yet. That's the longest I've ever gone.
We can't do one without mentioning that, Claude.
So I think it's like, it's priced in. He'll always say that's priced in already. Like he just is it priced in? We always kind of have this conversation. Is that priced in? Are the earnings priced in? Is the fact that this is happening priced in? I'll let you kind of lead the next question. I'm just going to plug my iWatch in because it's low on battery.
Yep, sounds good. All right. So we have a little bit of a deeper question here on doing some options trading here. So a question from Brad: what is our opinion about a covered call strategy?
Okay, so it's unfortunately, Brad, it's not what you want to hear, but I don't think I've ever met a retail client that's worked this successfully. A lot of people think they're doing it successfully. A lot of people brag about it at cocktail parties, and a lot of people are convinced that they're dominating, they're making way more money. Here's why. Options are the spread on options is so thick, large. Let's call it large. The spread on options is so large. So the price that the bid and the ask is, it's not like buying a stock, right? You'll have an option. So a covered call strategy is effectively owning a stock and selling calls. So you're selling the right to buy that stock at a future price, and you're collecting that income to do that. So a call option is the right to buy a stock at a future price. The put is the right to sell a stock at a future price. And if you're selling calls, they are covered, meaning you own the stock. And if someone buys you out of that stock, it means you're happy to sell that stock at that price. So let's say I own a stock at $50. I'd sell covered calls out of the money at $55. And I'm happy, I'm okay selling the stock at $65. I'm going to collect income to sell those options at $55. The problem is when stocks rally, they rally much further than $55 historically, and you're not getting any of that upside, right? Like the stocks move quickly typically, right? So in a flat market, you're fine. You're collecting income and you own the stock. So you're increasing your return a little bit. But when markets move a ton, you end up trailing performance by a significant amount because now you no longer own the stock, right? You've been called, you sell the stock goes from 55 to 65. You don't own it. You've missed that 15% rally. So if you look at your long-term returns, you end up trailing. There are ETFs that do this for you. They're also not that great because the spreads are so wide on these options. It's not like buying a stock where you could buy a stock at $49.90 and sell it at $50. These options will sell 10 cents and 30 cents or 20 cents and 45 cents. So to buy and sell, you're losing a significant amount. So I just don't think it's an efficient way to do it. It's significantly time consuming. And most of the time, if you look at longer cycles, you're going to underperform. That's my opinion.
Yeah, I would have said the same thing. To me, it's kind of like why have more work and more stress when you're likely not going to have the same performance? I'd much rather bet on a profitable company that's already profitable and just say, hey, do I think this company's still going to be profitable in 5 years, and let it sit there for 5 years than work on this up and down every day. But we're also not day traders here, right? We're managing real person's money.
Yes, it goes back to that question: are you being compensated for, in this case, the additional work that you're doing? Yep. And the answer is no.
And the risk, additional
work. And I think it's no. And I know some people are extremely religious about their covered call strategies. I have an opinion, and I was asked my opinion, so I gave it.
All right. Well, let's see if we've got another one. We do have another one. We have a question from Greg. Any thoughts on the NASDAQ for 2023? Yeah, it was in the dumps for 2022. So NASDAQ is, of course, the tech index. What are your thoughts on that for this year? Do you think we're going to see that reversal 2023?
So this is one comparison that I wanted to show. It's a comparison to 60. Oh, I thought this was NASDAQ. Yeah, it's the S&P 500, 66, 67 at 2022, 2023. So the reason I'm showing this is because again, we've talked about things that rhyme in the stock market. I anticipate a positive year for the NASDAQ in 2023. So I'll stop sharing this one because it's not exactly what I wanted to show, but whenever you see, so the NASDAQ was down 33% last year, 33%. Some of those companies, the largest and most profitable and highest weighted companies on there are the FANGs and the FANGMAs. So significant companies that are still very, very profitable, used to trade at 25, 30, 35 times earnings. I think rightfully so, because they were growing their earnings at 15, 18, 20%. Now they're getting a 15, 16, 17 multiple on their earnings. So I believe that at some point in every cycle we go through this, every single market cycle, growth stocks become out of favor at or near the bottom. And at some point they lead the recovery, or they don't lead the recovery, sorry. But once the recovery is happening, they get in favor again, and those multiples happen again. There will be a time, unequivocally, when the NASDAQ trades at its historical average of a multiple, and the Googles and Amazons and Facebooks and Microsofts and those companies trade at a 25 multiple, 25, 30 multiple. It will happen. I don't know when, but it will happen. And why? It's because, unless those companies have a dramatic shift in operation, and I don't believe that's going to happen. But if they're no longer able to be profitable, then maybe not. But assuming kind of business continues as is, they're going to trade at some point at a higher multiple. And if they have a higher multiple with their growth on their earnings, what does that mean for the stock price? It's significantly higher. So I believe the NASDAQ will recover. I don't know if it's going to be the leader here. So I think there's no problem. I think you still need to own some tech stocks. You cannot sell those because you don't want to miss that rally, right? You do not want to. So if you've owned a portion of your portfolio in tech stocks, as long as they're high quality, I don't think you want to sell those. So they might not lead the recovery this year. It's possible that it's maybe the second half of this year. It's possible it'll kind of trickle into 2024, but they will recover.
And it's still a pretty amazing opportunity to buy some good quality companies with much better basic numbers, much better fundamentals at this point, at prices where you can kind of feel a little bit better about buying them too.
Agreed.
All right. So let's see if we've got any more questions. I'm not seeing anything pop up right away. Oh, we do have another one. All right. Another sector rotation question from Bob. What are your comments with regard to consumer discretionary upside downside versus consumer staples upside downside? So basically a macro outlook.
Yeah. Okay. So the idea here is that consumer staples, they become more stable during market bottoms because, we're still buying our groceries, we're still buying our I don't know, Walmarts and those type of companies. Consumer staples are something that we need to buy. Consumers need to buy their staples. Consumer discretionaries are stocks that are items that we need to buy on discretion, right? So if we have spare capital, we will buy consumer discretionary stocks. And if we have staples, you buy them every week, no matter what. Historically, what happens is the consumer discretionaries, they are undervalued right now. And at some point they recover, kind of like the tech stocks. A little different, but so I think the question is, I'm just going to read it again here. What are your comments with respect to consumer discretionary upside, downside for consumer staples? Again, it's going to be it depends question on what your percentage is allocation in your portfolio, but you definitely need to own both. I don't think it's a situation where you ever go away from one and into the other, because what happens if it lasts longer than you thought it would? Now you're missing out on the consumer staples. Consumer staples are going to perform well here for a while. I don't know how long. And then the consumer discretionaries, you don't want to avoid them completely, because what if that rallies? And yet you don't want to go completely in discretionary, because what if it lags? What if it takes 12 months for those to recover? Meanwhile, the staples are doing really, really good. So probably not the answer you wanted, Bob.
No, but that was an excellent ad for why you should have a well-diversified portfolio right there.
Yeah. Some of those companies, like if you do both, you're not going to miss, right? You're going to perform well. You're going to own that recovery. And as the market recovers, you could look at switching your asset allocation.
Yeah, that's a great answer. I think we've got a couple more here before we wrap it up here for the day. The next one is from Steph. What is our outlook on China's economy for 2023? And how much do you think that will actually impact most retail Canadian investors' portfolios? I guess that's my question that I'm adding on top of that, just for discussion purposes.
Yeah. So if we look at the Shanghai Composite Index, give me a hard time here, but I think I got too many windows open. It's trading right now at the SSC Composite Index at 3,200. So if we look at the 1 year number, I think it's down like 9% over the last year. And if we look at the 5 year number, it's relatively flat. However, there's been a ton of growth here in China. Why? Because their GDP growth has been 6, 7, 8% over the last if we go take away the last 2 years. Before that, they were averaging 6, 7%. I could be wrong by 1% or whatever, but they were historically growing at a much, much, much faster pace than we were here. So you want to own, it's kind of like the argument for emerging markets. You want to own, if their economy is growing at 6, 7, 8%, that means the businesses are likely to grow faster than the businesses out here, because there's more spending, there's more dollars. And that's the emergence of the middle class, right? They're having a huge emergence of middle class in China. Now, this year, last year and the last couple of years, they've had serious issues with supply chain. The COVID thing is really, their reaction to COVID has caused they shut down more than other countries did. They also have civil rights issues that are happening. There's reasons that people are avoiding China, which has caused stagnancy. Is that a word? Stagnancy? A stagnant stock market. Mm-hmm. So do I think it's going to be up a ton over the next year or two? I don't think if you own some quality names in here, I think they're trading at significant discounts, and I certainly wouldn't sell them. I think you should own some exposure to China in your portfolio. Absolutely. I don't know if depends on your risk tolerance, depends on your growth, but maybe 2, 3, 5, 7%, something like that. The higher you are on the max growth scale, the more you should have, and the lower you are. I mean, if you're kind of a defensive investor and you have a relatively small amount to invest, I don't think you need to bother yourself with owning Chinese stocks if it's a small amount, because you don't necessarily need it, right? There's some really good Canadian. Yes, thank you, Diego. With definitions of stagnancy, thank you, producer Diego.
Yes.
stagnancy. I like it. But I do think the Chinese market will recover at some point. I don't know if it's now. I don't know if they have too many problems, but it will recover significantly. I think at some point in the next, this will be a big hedge, 2-3 years.
Yeah. Yeah. That's absolutely reasonable to go that far. All right. So let's see what else we've got before we wrap it up here for the day. We've got one more from Cal. What's your forecast for energy stocks? So oil. What are our thoughts on oil for this year and the coming year, I guess?
So if you look at XEG, which is kind of the Canadian capped energy index, I believe Cal is likely asking about Canadian oil and gas stocks. They're up 25% in the last 12 months, but they're only up 27% over the last 5 years. Remember, we had a very rough period there, 2018, 19, 20. Oil kind of disappeared off everyone's radar, and it was left for dead in April 2020, went negative. Stocks basically went to zero, and no one was buying oil and gas stocks. We bought some for clients, certain clients, depending on the risk tolerance and allocation in late 2020, 2021, and those did well. I do believe we've now been kind of flat for 6 months in the oil and gas sector. I believe, my belief, and this is not a political opinion. If you're asking me about the stocks, how they're going to do, I think that they will do remarkably well. I think I'm very, very bullish on oil and gas over the next 5 years, just because of the macro factors. We're like, there's just more and more population, more and more people driving cars, more and more people, businesses using oil and gas. We're consuming like we never had. Every single month, we're consuming more and more and more.
Emerging markets are using it more.
Markets, yeah. They're not buying a ton of EV vehicles in Brazil and India, right? They're buying gas guzzling vehicles, and not just the consumption for vehicles, the consumption for heating houses and corporations and manufacturing plants, and that whole emerging market thing is leading to much more demand, and the supply is shrinking. So it's a classic supply and demand problem that I think is there's another several years here before we start to reach a situation where we have to start reducing our exposure because of kind of the green argument.
All right. So we are just about done here for the day. I think we're going to wrap it up here unless we have anything else. Did you have anything else that you wanted to cover, Rob, before we kind of say goodbye to everyone here? Because I know we had a couple of charts here. Did you cover everything you wanted to cover?
Just one last thing about back-to-back negative years. So back-to-back down years for U.S. equities are very rare. So last time it happened was 20 years ago in 2001, 2002. But before that, it was 1973. And before that was the Great Depression. So we're talking 3 times in the last 100 years, right? So historically, when the market corrects 20%, it bounces back to the tune of 91% of the time. It's a positive year the following year. So the average return is historically in that high teens. So it's again, I don't know what will happen, but I do know that historically, this is a very, very good time to own equities. And I wouldn't be adjusting your equity exposure now. So I know some clients that had capitulated in October, November. They were like, I can't do this anymore. Sell my stocks. Obviously, they're regretting that now. But I don't think you need to continue to own equities now. If your asset allocation is wrong, maybe it's a time for a discussion with your stock, with your portfolio manager or your investment advisor. And if you're not sure, go to www.speaktorob. We'd love to book a no obligation consultation. Guys, don't forget to subscribe. Please subscribe. We're trying to get to 10,000 subscribers. So subscribe, smash the button, ring the bell so you're notified. You're notified about when we put out new content. And make sure to follow Run with Rob, and make sure to follow my brother and I's podcast, The Running Journey, which will be launched in a couple of weeks. Tania, I'll let you have the final word.
Thanks so much for joining us, everyone. I hope everyone has a wonderful, happy, healthy, prosperous 2023.
Cheers.